Accounting equation. Every business transaction has two aspects. One aspect is debited, other aspect is credited. Both the aspects have to be recorded in accounts appropriately. The equation is as follows. Assets is equals to equities, or assets is equals to liabilities plus owner's equity. The equation is based on the principle that accounting deals with property and rights to property, and the sum of the properties owned is equal to the sum of the rights to the properties. The properties owned by a business are called assets, and the rights to the properties are known as liabilities or equities of the business. Equities can be subdivided into equity of the owners, which is known as capital, and equity of creditors, who represents the debts of the business, known as liabilities. These equities may also be called internal equity and external equity. Internal equity represents the owner's equity in the assets, and the external equity represents the outsider's interest in the asset. Based on the bifurcation of equity, the accounting equation can be restated as follows. Assets is equals to liabilities plus capital, or capital is equals to assets minus liabilities, or liabilities is equals to assets minus the capital. Rules of accounting equation. The following rules help in making the accounting equations. First, assets. If there is increase in assets, this increase is debited in assets account. If there is decrease in assets, this decrease credited in assets account. Next, liabilities. When liabilities are increased, outsiders' equities are credited, and when liabilities are decreased, outsiders' equities are debited. The capital. When capital is increased, it is credited, and when capital is withdrawn, it is debited. The expenses. Owner's equity is decreased by the amount of revenue expenses. And the income or profits. Owner's equity is increased by the amount of revenue income. Financial statements. Financial statements represent a normal record of the financial activities of an entity. These are written reports that quantify the financial strength, performance, and liquidity of a company. Financial statements reflect the financial effects of business, transactions, and events on the entity. Companies prepare 4 financial statements from the summarized accounting data. First is balance sheet, income statement, retained earnings statement, and the statement of cash flows. Balance sheet. Statement of financial position, also known as the balance sheet, presents the financial position of an entity at a given date. It is comprised of the following 3 elements. The assets. These are something a business owns or controls. Examples are cash, inventory, plant, and machinery. The liabilities. These are something a business owes to someone. Example are creditors and bank loans. The equity. This is what the business owes to its owners. This represents the amount of capital that remains in the business after its assets are used to pay off its outstanding liabilities. Equity therefore represents the difference between the assets and the liabilities. This is an example of a balance sheet. Things to remember in balance sheet. Balance sheet reports the assets, liabilities, and stockholders' equity at a specific date. Assets listed at the top, followed by liabilities and stockholders' equity. Total assets must equal total liabilities and stockholders' equity. The ending balance in retained earnings is needed in preparing the balance sheet. Here, you could see the retained earnings. Retained earnings statement. Statement of changes in equity, also known as the statement of retained earnings, details the movement in owner's equity over a period. The movement in owner's equity is derived from the following components: the net profit or loss during the period as reported in the income statement, share capital issued or repaid during the period, dividend payments, gains or losses recognized directly in equity, example, the revaluation surpluses, and the effects of a change in accounting policy or correction of accounting error. This is an example of a statement of retained earnings. Income statement. Income statement, also known as the profit and loss statement, reports the company's financial performance in terms of net profit or loss over a specified period. Income statement is composed of the following two elements. The income, this is what the business has earned over a period. Example, sales revenue, dividend income, etc. Expenses, these are the costs incurred by the business over a period. Example, the salaries and wages, depreciation, rental charges, and etc. Net profit or loss is arrived by deducting expenses from income. These are the things to remember in income statement. The reports revenues and expenses for a specific period of time. The net income is the revenues exceed expenses. Net loss is expenses exceed revenues. Remember, the net income stated in the income statement is needed to determine the ending balance in stockholders' equity. Statement of cash flow. This is an example of a statement of cash flows. Cash flow statement presents the movement in cash and bank balances over a period. The movement in cash flow is classified into the following segments. The operating activities represents the cash flow from primary activities of a business. Investing activities represents cash flow from the purchase and sale of assets other than inventories. Examples is purchase of a factory plant. Financing activities represents cash flow generated or spent on raising and repaying share capital and debt together with the payments of interest and dividends. Cash flow statements answers the following questions. Where did cash come from during the period? How was cash used during the period? And what was the change in the cash balance